If you look at the corporate graveyard over the last 50 years, you will notice something terrifying. Brilliant companies with billions in funding vanish overnight, while boring, unsexy businesses quietly print billions year after year. How is that possible? Charlie Munger spent his entire life hunting down the answer to that exact riddle, tracking down a rare breed of enterprises that do not just survive chaos, but actually weaponize inflation and raise prices for decades without losing a single loyal customer. But what is the hidden mechanism that allows them to do this in plain sight, and why do 99% of investors look right past it? Let us investigate the crime scene of modern business and uncover the secrets of the ultimate economic fortresses. Imagine standing inside a corporate boardroom during a severe economic downturn, watching executives panic as supply chain costs soar and consumer demand evaporates. Most companies react with absolute terror. They slash their prices, slash their marketing, and desperately try to undercut their rivals in a race to the bottom that ultimately destroys their profit margins. They treat price as their only weapon, and it usually blows up in their faces. Charlie Munger watched this destructive cycle happen for decades with cold, analytical fascination. He realized that ordinary businesses are fragile because they compete on terms dictated by everyone else. But a tiny, elite fraction of businesses operate under an entirely different set of physical laws. They do not fear inflation. They do not fear recessions. In fact, when costs rise, they simply send a letter to their customers raising prices by 10, 15, or 20%. And their customers pay it without blinking. How is that even possible in a free market? What kind of spell do these companies cast that makes price increases feel like an afterthought? The investigation begins not with financial charts, but with human psychology. To understand how a business can raise prices for decades, you have to look at the invisible friction of everyday life. Think about the software tools you use to run your professional life, or the specialized equipment a hospital relies on to treat patients, or the logistics network moving goods across a continent. When you integrate a service deeply into your daily operations, the cost of switching away from that service is rarely just about money. It is about operational terror. It is about the risk of system failure, the months of employee retraining, the terrifying downtime, and the sheer mental exhaustion of starting over with an untried alternative. Munger understood this better than almost anyone on Wall Street. He often pointed out that the single greatest moat a business can possess is not a patent, a trademark, or a massive advertising budget. It is psychological habit reinforced by deep operational integration. When a business becomes the invisible plumbing of your daily routine, you stop shopping around. You stop caring about competitors. You just want things to work. And when the provider of that plumbing raises their prices, you sigh, sign the renewal contract, and keep working. The corporate investigators who track these companies find a recurring pattern. These rare enterprises do not chase rapid, explosive growth. They do not try to reinvent themselves every quarter with flashy marketing campaigns. Instead, they find a specific, highly critical niche in the economic machinery of the world. And they anchor themselves there so permanently that time itself becomes their greatest ally. Think about a toll bridge spanning a massive river. If you want to get to the other side, you do not build your own bridge. You pay the toll. As the cost of living rises over the years, the toll operator adjusts the price. Inflation pushes the value of money down, but the toll goes up. The profit margins widen effortlessly, requiring almost no new capital expenditure, no heavy machinery upgrades, and no massive factory expansions. That is the holy grail of business economics. And yet, most investors completely miss it because they are blinded by the bright lights of high-tech startups promising overnight disruption. They fall in love with top-line revenue growth, ignoring the brutal truth that high growth often requires massive, unending capital reinvestment just to stay alive. Munger called this the treadmill of perpetual capital consumption. You run faster and faster, generating billions in revenue, but at the end of the year, your free cash flow is near zero because every single dollar had to be poured right back into fighting off competitors. That is not a fortress. That is a trap. To find businesses that can raise prices for decades, you have to look for the exact opposite profile. Low capital intensity combined with astronomical switching costs. Let us examine a real-world case study of this forensic mystery in action. Consider industries that provide critical compliance, regulatory tracking, or specialized enterprise data. A company provides a software solution that tracks complex legal and tax filings for thousands of multinational corporations. The software is embedded directly into the daily workflow of corporate attorneys and financial officers. If the software crashes, millions of dollars in legal penalties could instantly hit the client. Now, imagine this software company increases its annual subscription fee by 15%. Does the corporate law firm drop the service to save a few $1,000s? Absolutely not. The risk is astronomically higher than the price increase. The attorneys pay the higher fee instantly because their primary goal is risk mitigation, not cost-cutting on mission-critical tools. The software company captures that 15% increase straight to its bottom line. Zero new software code was written. Zero extra servers were purchased. Zero additional employees were hired. It is pure, unadulterated economic leverage. Munger analyzed these exact corporate DNA strands throughout his legendary partnership at Berkshire Hathaway. He loved businesses that possessed pricing power because pricing power is the ultimate shield against inflation. When fiat currencies lose purchasing power, companies without pricing power get crushed between rising material costs and price-sensitive consumers. Their margins compress, their earnings drop, and their stock prices collapse. But the company with a deep economic moat simply passes the inflation burden directly down to the consumer. The consumer pays because the alternatives are worse, and the business preserves its purchasing power intact. It is an invisible defense mechanism operating silently beneath the surface of the global economy. This leads us to a profound contradiction that confuses many novice investors. Why do these companies rarely look exciting on a spreadsheet? Why do they often appear boring, quiet, and entirely unglamorous? Because true economic strength does not need to advertise itself. The most powerful businesses in the world are the ones you interact with so seamlessly that you forget they are extracting a profit from your daily routine. They do not need loud commercials. They do not need viral marketing stunts. Their reputation, their integration, and their sheer indispensability do all the heavy lifting. As we dig deeper into the mechanics of this pricing dominance, another layer of the investigation reveals itself: the impossibility of replication. Suppose a well-funded venture capitalist looks at one of these dominant toll bridge companies and says, "We are going to raise $2 billion, build a better version of this product, and undercut their prices by 50% to steal their market share." It sounds like a foolproof business strategy on paper. In reality, it is financial suicide. Why? Because enterprise customers do not switch critical infrastructure to save money if it introduces operational risk. Trust takes decades to build and seconds to destroy. A corporate executive risking their entire career on a cheaper, unproven startup software to save a few dollars on licensing fees is taking a career-ending gamble. If the startup fails, the executive loses their job. If they stick with the established, expensive provider, nobody questions the decision. Therefore, capital alone cannot buy a moat. Money cannot compress 30 years of proven reliability and deeply ingrained human trust into a 12-month product launch. Time is the ultimate barrier to entry, and time cannot be accelerated with venture capital funding. This brings us to the core mental model that Munger championed throughout his life: inversion. Instead of asking how to build a successful business, he asked, what destroys businesses over the long term? He looked at commodity businesses, businesses dependent on raw material price swings, businesses with low switching costs, and businesses that had to constantly innovate just to keep their customers from walking away. He systematically avoided every single one of them. Instead, he sought out the anomalies, the businesses that customers depend on so completely that they can raise prices year after year, decade after decade, without facing a single serious threat. When you start viewing companies through this forensic lens, the entire landscape of investing shifts. You stop caring about next quarter's earnings beat. You stop worrying about short-term macroeconomic panic. You start asking a much deeper, more fundamental question. Will human beings and corporations still be utterly dependent on this specific service 20 years from now, no matter what technology changes around them? If the answer is a resounding yes, you have found a rare compounding machine.